The Goldilocks era of globalization is officially over. In 2026 and beyond, for you to be successful in investing, you really need to understand how the global map is being redrawn and how supply chains are being rejigged. Why do I say this? It's because what you are seeing in the two recent wars that has happened over the past 5 years, you see sovereignty, national sovereignty being prioritized, as well as supply chains being localized. So, going forward as an investor, these are the few macro trends that I'm really focusing on to help me and my clients actually determine what are the value chains that are actually structural bottlenecks, as well as how do we actually benefit from these bottlenecks. Hello everyone and welcome back to the channel. My name is John, former engineer turned full-time investor, currently wealth planning director at Phillip Capital Malaysia, as well as the author of the book Malaysian Multi-Baggers, in which I show companies within Malaysia that have multi-bag shareholder return, 10, 20, even 100 times shareholder returns. So in the past 50 years after the end of World War II, there has been a globalization nature for industries and also the economy, in which shipping costs got cheaper and cheaper. The invention of the 40-foot container really brought down structural changes and lowered the cost of globalization, meaning you can have China being the factory of the world, have them manufacture plastic product or any product, and having that product shipped anywhere around the world will even be cheaper than that of having those products manufactured locally, due to increase in labor costs, due to inefficiencies where industries don't change. So that has been going on for the past 70, 80 years, and now that's changing because of countries or sovereignties around the world realizing that upon a war, upon a COVID disruption, you really want to have those things in your backyard, even though it costs more, maybe a little bit, maybe a lot more. And this has really changed or position or transition. I think the word I was looking for is transition. Global efficiency into regional security. Look at what COVID did in trying to localize food supply. Look at what COVID did, or the war did, in localizing defense and munition, especially for countries in Europe where they couldn't rely entirely on the US Senate or the US suppliers actually supplying arms to them, right? So this, I give you a clear example of certain industries. For example, the defense industry had a spending boom, notwithstanding what happened when Russia invaded Ukraine, and then you see that propagate into companies, defense companies, taking advantage of stocking up all these munitions. Now you see in the Middle East, you see that even though US has bases around the world, very concentrated in the Middle East because of protection of oil and gas supply chains. But now if you see increasing tension in Indo-Pacific as well, right? It's not just the Middle East. Increasing tensions between China as well as Taiwan or Japan, or between North Korea and South Korea. I think defense spending hit a record high. It exceeded 2.9 trillion. That's roughly 2.5% of the total global GDP. So it's not just about hardware. So we can think about the defense spending, but we also have to think about how is this defense spending being financed. It's actually financed by debt, and it's creating a structural inflation floor, because sovereigns around the world, when you need to feel protected, you're willing to up your defense spending, and government resources and budget will be diverted towards there, and that will cause supply demand for other industries. What do I mean by supply demand for other industries? Because money is diverted towards spending, then less money is being spent towards healthcare. Malaysia is also seeing this already. And when healthcare demand scarcity exists, or supply scarcity exists, demand will actually go up and inflation will actually rise. So yeah, I think we really have to think about how these global efficiencies has completely changed into regional security. and how that actually gives rise to inflation. That's the first theme. The second theme I look at is the persistency of inflation and the AI pivot. What do I mean? Inflation rate seems to be sticky. I mean, in the US, they're struggling to hit 2-3%. In Japan, is struggling to hit any inflation rate. It's in the past, it used to be deflationary. Now, with the Bank of Japan raising interest rates, they hope to find they hope to increase inflation. But wage growth remains very, very sticky, especially even in countries like Malaysia, where labor cost is cheaper than most Western countries. But even then, wage growth has been stagnating, and it doesn't help that the energy shocks because of the war in the Middle East has kept headline inflation very, very volatile. And in the Eurozone, even though they're not, they are at war because of the Russian invasion of Ukraine, but they are also being impacted due to the Middle Eastern war, and projections of inflation is roughly 2.6% for the Eurozone area. Okay, now there's a lot of talk about AI. I'm pretty sure you've been bombarded every day about AI this, AI that, how AI is going to help efficiency, how the workforce is being trimmed because of AI efficiencies. The worry is that if AI does not deliver on the promise of efficiency, and then with people being cut off jobs, and the current market valuation that is being accorded to these AI companies, if all these promises of efficiency does not materialize, I think the bubble would pop soon. Yeah, I mean, there's beneficiaries for those people who build out these data centers or hyperscalers, but now on the end result side, the efficiency that is promised to us by AI, if that does not materialize over the next 3 to 5 years, will that really justify the premium valuations that we're according to AI stocks today? So that's something that you have to really watch out for. Looking at where Malaysia is, we are kind of a beneficiary somewhat, and yet we are also stagnating of somewhat, because China plus one strategy benefits Malaysia because of its semiconductor hub, because of its trading hub that allows localization here, or regionalization here, and then being able to use Malaysia as a stepping stone or a springboard to export to the US, which is a very big market for Chinese companies, right? But having said that, at the same time, a lot of companies that are or sectors or industries within Malaysia serve a very small market. When I say small, it's relative to countries like Indonesia with a 330 million population versus Malaysia 33 million. It's a 10x difference in terms of population size and in terms of addressable market. So if Malaysian companies are confined towards that, and if inflation costs is wage inflation or raw materials inflation, it will cause margin compressions to these kind of businesses or industry. And that's why when we look at rising interest rates as another possibility for Malaysia and even in the US, I think that's where you have to be very cognizant about what industries will have the largest negative impact within Malaysia that will hit your investment, will you hit your portfolio. So yeah, that's the second theme, about persistence inflation, about the AI pivot, and about efficiency. Last theme that I'm looking at is actually energy security versus the green transaction. Obviously, ESG is all the rage over the past 5 to 10 years. But now with the growth of the data centers and the inability for green energy to catch up with all this energy demand needed for these data centers, we're entering into some kind of a mixed era where while renewables energy is growing at a much faster clip because of reduced construction material, reduce even things like photovoltaic cells for your solar panel is coming down. It fluctuates, but it's on the downtrend. I think energy security is a major sovereign concern. It's not just Malaysia, it's any country around. It's a sovereign concern, because if you're adding data centers into your backyard and the demand for electricity or even other resources like water is growing up, then who gets to determine which one is priority? Is it the FDI data center, or is it local resources being local residents being starved of local resources. And why this theme actually is beneficial is because while everybody is talking about the chip, talking about the NVIDIAs of this world, talking about the TSMCs of this world, there's a lot of utility systems that goes behind the scenes to actually support the industry. Things like power turbines, things like solar cells, things like construction of water utility plants. I think that in itself is a huge alpha generation over the next 5 years. Whether or not, like the earlier team I talked about, whether or not AI can actually deliver on the promises of efficiency, that's remain to be seen. But the players that are killing it right now are those that are part of the value chain that constructs all this. I think that's something that this team will have sustainability over the next 5 to 10 years. So if you think about from a financing angle, because of the military spending that I mentioned earlier, that a lot of resources are being diverged into regional security, the scarcity of resources being taken away from other sectors, like for example healthcare, because the government hospitals cannot handle the queue anymore and they're not going to expand. What does it drive? This is an example. It will drive more and more people towards private healthcare, even though they may not be able to afford it. So this is one example. Another example would be because all these resources are the government anywhere around the world is trying to grow their tax income, but then it's being diverted to industries that they see as a priority, but may not be a priority to may not be directly beneficial to the society. For example, infrastructure building or even education. Then what will happen is like parents will say, nope, I can afford it a little bit. I'd rather send my kids to private education rather than public education. Then you see inflation, lifestyle inflation will go up, and yet the cost of living goes up, and they are stuck in the middle. And this is where the middle income trap will come back to haunt Malaysia again. I mean, Malaysia has always been trying to move its society into the high income nation, but all these divergence of resources are not being spent on developing better human resources, putting in better policies, setting up physical infrastructure that benefits more direct investments, upskilling. It's just this vicious cycle. So for all my private mandate clients, we meet up at least once a year during the AGM, and I share all these trends, macro trends to them, to help them understand the industry selection, company selection that we have in their portfolio. Because if you're just looking at financial statements of a certain company, and yet the macro trend of the sector that company is involved in is on a declining trend, then no matter how well you analyze or dissect the financial statements, you're betting something that is in a decline. And I think that's very, very dangerous as an investor. I've always been a bottoms-up investor. That means I look at individual companies before I look at an industry. But over time, you realize that you have to look at both, right? You do the bottoms-up individual company, but then if you don't understand the structural, the industry structure in itself, you may be betting in a very good it looks financially good for a company, but in a totally wrong industry. Then your entire hypothesis is just blown away. So let me know if you like the book. There's a link in the description. If you want someone to have a look at your portfolio, no obligation, kind of consult, there's also a link in the description. See you guys in the next video.